Good afternoon. Good afternoon. It's Monday, the 2nd of March. Welcome to another edition of Monday Market Picks. My name is Thilan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. What a difference a weekend makes. The US and Israeli attacks on Iran has put the markets on risk-off mode, and the path of the conflict is still very much unclear, and also very unpredictable. So I think the markets are going to remain on risk off, and I think there's going to be a lot more focus on safe haven assets as we go through the next few days and weeks. So that's what we're going to be focusing on today. What is the impact on Singapore from this conflict, and what stocks stand out, and as well as what stocks are impacted from this conflict. So I will go through that. Also, the result season is just over for the banks. What are some of the key takeaways, and how does our banks' preferences stand right now? And then Jarek is turning bullish on the tech manufacturing space again. We will hear from him on his top picks and what are his reasons. And as always, we have our chart guy with some fresh trading ideas as well. So quite a lot to go through in today's show. But let's start with Jarek and the tech manufacturing space. Sharik, you are turning a lot more positive on this sector after quite a few quarters of being fairly bearish. What's changed?
Hi, Thilan. Thanks for having me. Yeah, so you're right. I've changed to I've become more bullish on the whole tech sector, mainly because I think the guidance of the three companies in the semicon space has actually changed to more bullish. So I think if you look at it, their customers, the global customers like AMAC, LAM, and ASML, have all very strong order books, and I think in their recent results they have guided for even stronger order books. But we have not seen that flow down to the Malaysian and the Singapore players yet. That's why we were a bit bearish previously. But going forward, it seems like 2026 is the year for the super ramp up. We have seen AEM guiding for much higher revenue guidance of 15-20% growth. And then we also seen UMS guiding for ramp up in both customers for 2026. We just entered the results call earlier. And Frencken is also sort of guiding for higher semicon revenue for 2026. So it does seems that things are changing. Orders are flowing down finally to these players, and they are likely going to ramp up for 2026 for their key customers.
Got it. I mean, let's get a bit more stock specific right now. Let's start with AEM, where you've upgraded the stock to a buy, and after quite a few quarters of a sell. So what's driving this?
So I think if you look at our basis for a sell, even though 2025 PATMI was a lot, 100% higher than what we expected at 17 million, but it was from a very low base. So at 17 million, if you look at the market cap of AEM back then, even before the rise, it was 600 over million. It was totally unable to justify that kind of valuations for 2025. But in 2026, what has changed is that management, previously was not really guiding for a revenue increase, or rather not much, but now they are actually guiding for 460 to 510 million revenue increase, revenue target for FY26, which is close to 15 to 20% higher than that of FY25. That is a big change in our view, and also in the market's view. That's why the stock price has ran up so significantly. Basically, they do expect their AI HPC customer that they won, which we suspect to be AMD, to become its largest client, overtaking Intel, which is its long-standing largest customer, since like 5, 6 years ago. And that is actually quite a big news, because it means that AMD will likely ramp up more significantly in 2026 and also in 2027. And with revenue guidance of 46 to 510 million, basically your margins in the terms of gross wise and net wise will also expand, because the test cell actually command much higher, test cell solutions actually command much higher margins than their basic EMS acquisition that they did a few years ago. And we expect significant margin expansion for FY26 to 28E. And also in 2027, their memory customer, which we suspect to be Micron, will likely ramp up in 2027. And in 4Q26, we will likely see production test batch starting. And also AEM is trying to secure its fourth customer, which could provide growth for the from 2027 to 2030. And the fourth customer could potentially have some news in the next few months. So all in all, it's a very different change in outlook for AEM. We do expect, the next few years to be quite a boom for AEM, and AEM will likely be a key beneficiary of this AI capex cycle.
Okay, got it. Now, you've also upped target prices quite notably for Frencken, UMS, as well as Venture,
Yeah.
and you're keeping your buy calls on all these stocks. Can you give us, a quick view on where you're coming from for these stocks?
Sure. So for UMS, I mean, they have two key clients. One is the new client is Land Research. The other client, the old client is AMET. So for Land Research, the management has guided in the call earlier that they expect revenue from Land Research to double from 2025. So they almost double from 2024, and now it's going to double from 2025. 2025, the revenue from the new customer is close to about 30 over 40 million. So this number is going to double. That means that another 30 over 40 million revenue increase for UMS. And then also for their existing customer, which is AMET. AMET, I mean, they have signed a new 3-year system, 3-year contract with AMET to continue to provide the integrated systems. And not just that, AMET is having a strong guidance for UMS. I think they're guiding for close to 15-20% increase for 2026. And also for the new packaging system, I think AMET has thought of reach out to UMS to continue working with them for the new system. So I think this is the first time UMS is actually getting a new project from AMET, which actually means potentially higher margins and higher volume going forward. So if you look at
Hmm.
UMS, they're also having a good story where both their only customers in the semicon space are ramping up for 2026. So it seems like UMS outlook has also changed for the better. If you look for 2025, the revenue growth is only a slight, a few percent for compared to 2024. But 2026, you'll see a 15, 20, at least a 20% revenue growth for UMS. So it looks to be like, the ramp up is finally here, that a lot of people are waiting for, including me, for all the
Yeah.
semicon EMS players. And then for
Okay.
Frencken, basically Frencken is also guiding for AMET to ramp up significantly more in 2026. And even though there might be some weakness in the first half for ASML because there's a lot, I mean, ASML is high inventory levels, which will likely need to be drawn down first. But AMET's ramp up is more than enough to cover that of ASML's decrease. That's why Franken is also guiding for higher semicon revenue. But going forward in the second half, we do expect once the ASML drawdown of inventory is over, they will also start to ramp up for Franken. So we are expecting ramp up for ASML and together with AMET, in the third Q or fourth Q of 2026, which will result in a potentially much better year for Franken as well for 2026. But on the packing order wise, it does seems that AEM it will be the key beneficiary, followed by UMS and then followed by Franken. I think Franken is a bit more conservative, so they will likely have more clarity only after the first Q. But we do expect a ramp up in third Q or fourth Q for Franken as well.
Okay. Excellent. Great. Thanks, Derek, for dialing in.
Welcome. Yes.
Now, Now let's turn to the main topic of today, the Iran conflict. So let me give you some quick thoughts on that. The escalating US and Israeli attacks on Iran have significantly increased geopolitical uncertainty, driving a spike in global volatility and risk premiums. And we're seeing that playing out in the markets today. For now, we assess that Singapore's exposure is largely second order. The primary transmission channels are oil prices and capital flows rather than direct trade or credit linkages into the Middle East. In this environment, we've talked about Singapore's structural certainty premium before. Now it actually becomes even more relevant. Policy credibility, political stability, and also strong fiscal buffers position the market as a relative safe haven. And we continue to reiterate our 5,600 STI target for the year end. There's a audience question here asking about whether they should be buying the dip on the STI, which is down today. We remain bullish on the STI for the year. We continue to expect safe haven flows coming into Singapore, helping to anchor financial conditions and also provide some systemic downside risk protection as well. From a sector perspective, we see incremental positives emerging for the banks, non-bank financials, healthcare, industrial, small and mid caps, internet platforms, as well as telcos. Now, on the other hand, transport and selected consumer segments face mixed to slightly downside or headwinds as well, primarily driven by fuel costs as well as potential disruptions to supply chains. For the banks, direct Middle Eastern exposure is pretty limited. At the same time, these banks have been pretty aggressive trying to source more AUM for the private wealth side from the Middle East. So we think that this could actually help increase wealth flows from the Middle East going forward. And that'll actually help with fee income coming through, particularly from wealth management fees. Plus, higher oil prices may drive inflation, which may actually slow the Fed rate cutting cycle, which will actually help put some downside support for net interest margins. Now, non-bank financials may benefit from stronger brokerage activity and asset management flows, along with increased demand for things like safe haven assets like gold, particularly for the pawn brokering players. Industrials and small and mid caps could see thematic tailwinds from higher defense spending, energy security priorities, and recovery in the oil and gas complex. Transport remains the most exposed sector, with higher jet fuel costs and possible airspace disruptions, raising risks to aviation margins. Although some of this should be partly mitigated through hedging and fuel surcharges. Now, turning specifically to stocks, SIA faces potential airspace rerouting and elevated unit costs if Middle East corridors continue to be disrupted, while higher fuel prices remain a key margin variable going forward. SATS could see near-term upside. We've seen the stocks actually coming up, but we actually think that there could be near-term upside if maritime disruptions drive substitution towards air freight, supporting cargo volumes and yields. Wilmar presents a mixed profile. Higher crude prices are normally good for palm oil prices, but elevated oilseed inputs and freight costs may compress margins on the other side. Now, among the beneficiaries, defense-linked names like ST Engineering and Add Value Technologies, I think that's a question that's by the audience is also asking, could see increased order visibility. And also, I think, given the fact that we've seen live images of drones hitting civilian buildings, we think there'll be a lot more demand and a lot more understanding by the street in terms of drone jamming software and drone anti-drone technologies which Add Value provides. So that's something to watch out for. In financials, DBS, OCBC, and UOB remains relatively insulated on direct exposure, but could gain from some of these safe haven flows, particularly for wealth. But we'll be keeping an eye on asset quality, particularly from SMEs who might have impacts from higher input costs. Overall, volatility is clearly elevated. So far, Singapore's relative positioning suggests downside risks remain fairly contained, with selective sector and stock level opportunities over the next few weeks. So do keep a watch out for that. There's a lot more in our note today in the newsletter, so do have a look at that. That goes through on a stock by stock, sector by sector basis. Now, moving on to banks. We have come to the end of the fourth quarter reporting season for the banks. Now, here are some of my thoughts on the overall sector as we keep an eye out for 2026. We are seeing NIM compression stabilizing, and it is unlikely to see the double-digit basis point contraction that we saw in 2025. Funding cost discipline is pretty good. We've seen the bank quite aggressively cutting deposit rates. even though loan yields are still fairly weak. So I think you're still seeing all the banks chasing after the same few customers. But we think that'll actually start to broaden out in 2026. We're going to see a lot more construction loans, manufacturing, and SME loans coming through. And remember, these tend to be more higher yielding than before. Now, fee income is surprising on the upside, especially in wealth. Rotation from deposits to investments is still very much in the early stages. Under 50% of bank AUM is invested. So there's quite a bit of upside there as clients look to invest more from deposits into more wealth management products. Asset quality is also pretty benign. Commercial real estate is a known risk, but now it's a lot more manageable with quite a bit of buffers being put in place. We think credit costs will normalize going into 2026. Of course, the Middle Eastern conflict is something that we will watch out for. Now, specifically on OCBC, we have downgraded the stock to a hold. Capital return expectations for OCBC is resetting downwards. Remember, this was one of our top picks at the start of the year, and a large part of that was based on the new CEO looking to pay out more dividends. But now he's unveiled a strategy called the Next Frontier, which is tilting more towards growth than dividend payouts. There seems to be a shift towards retaining capital. Despite the fact that most of the strategies that he has announced are actually fairly capital light. So that's kind of, trying to put a square peg in a round hole. And we think that there might be potential for M&A, particularly in Southeast Asia. So there is, that risk to kind of worry about. Plus, there is also OpEx and execution risks at the early stages of any strategy. So something that we'll be watching out for as well. So our preference now goes back from OCBC back to DBS, which offers very good dividend yield clarity and also superior ROEs. But our least favorite pick remains UOB, given the structural overhangs in their retail business and asset quality as well. So do have a look at all our notes, which are available in our newsletter today. Now, a question on StarHub from a client here. We still remain positive on the stock, but there are some concerns in terms of overall OpEx for StarHub, which is not coming off. So that's something that we are kind of watching out for, which does create a bit of concerns around the overall dividend yield. Now, these concerns don't particularly exist for Singtel, which is quite nicely executing their strategy of pivoting more and more towards AI and data centers, as well as capital recycling as well. So on a relative preference basis, Hussaini has shifted his preference to Singtel after the fourth quarter results. There is a note on that in our newsletter as well. Now moving on to the technicals, our chart guy is back with two new fresh buy ideas. One is SATS, which we mentioned as one of these Iran conflict beneficiaries as well. It continues to hold above its uptrend line and all major moving average lines. The broader bullish sentiment remains intact, so do have a look at that chart. And stock weakness might be an opportunity to enter SATS. We also like ASL Marine, which has been in a healthy and steady uptrend with price trending within a well-defined uptrend channel. So do have a look at that chart as well. Again, quite positive for ASL Marine. In terms of announcements and events this month, we've got a whole host of economic data coming out, PMI data coming out on the 4th of March, retail sales on the 5th of March, unemployment rate on the 13th of March, something that we'll be watching out for. Nordex is out on the 17th March. I think some of these figures will be pretty critical to see how MAS will react in terms of whether they will tighten more or loosen more going into the next policy cycle. As you said, if oil prices remain elevated, that does raise Singapore's inflation risk. Our macro team does expect inflation to be higher this year than in 2025. So you may see the MAS tighten a little bit more. So something to watch out for as we progress through the next few weeks. With that, unfortunately, we are out of time. Thank you so much for joining us this week. We will have a lot more. Do keep an eye out for our research coming out over the next few days. We will be covering this Iran situation as much as we can as things develop. And thank you for joining, and have a successful trading week this week, and we'll see you next week.